Hello, everybody. Thank you for joining us for today's public webinar. Good morning or good afternoon to you, Jim. Well, it's morning for Jim, but it's afternoon for some, I'm sure.
Yes, it is 9 o'clock here. All right. Most of you, if you've joined us before, you know we do this to draw attention to our educational programs. The next program we have coming up is the Primer. The Primer is our low-cost course that allows you to take a look at what we do and see if it's anything that that appeals to you. And it starts, I believe it's the 10th of next month and goes through the 18th.
Yes, it runs from April 10th to the 18th. So it's an 8-day course.
First 4 days are linear. The last 4 days we spend looking at the markets, live markets, along with reports. We are not going to do a summer primer. I'm going to be traveling this summer. Normally we do a summer primer, but this will be the primer. If we do another one this year, it would be in the fall. The other thing that I'll mention briefly, we just finished an intensive, and I think we had a really good, solid intensive. The response was great. We're going to do an intensive in the month of June. There is a prerequisite for that intensive. You either have to have attended a prior intensive or completed the foundational e-course, and there's no exceptions to that. So, but if that's something that might interest you, you want to look into the foundational e-course so you get plenty of time to get it under your belt. Okay, to start with, I don't know how many people have figured out what's going on here this morning, but it absolutely is unbelievable how perfect it is. I've been following this for some time, and this, I don't know what in the world I just came up there. What did I do? What did I get up there, Jen?
I don't know. You might have clicked on something.
How do I get rid of it?
On your start window. Just click on your toss window there. Yeah.
There. No, that didn't do it.
No, just click back onto your window trader or toss, whatever you want to show.
Okay. This is not what I normally do, but my view of the market is there is no such thing as normal. I look and see what are the trading community doing, and because we are constantly competing with the traders. And a couple of days ago, the low on the line here was, I think it was 52.01. The low for the day was like 50, a couple ticks under that, and it's gone in just a couple of days. Well, maybe it was this day. It's gone all the way back now, right up at the high. And it's just unbelievably mechanical. When you see this is normally an indication, when it's this perfect, that what we're dealing with are short-term traders. I think the majority of traders we're seeing right now are the laggards. We break it down into innovator, early adopter, early majority, late majority, laggards. And the laggards are the last ones into the market, driven by FOMO, fear of missing out. And a lot of people misunderstand it. They can take the market a long way. They can take the market an awful long way. But if you look, we went here about, forget this day. Let's go 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, about 20 some days. The market just back and forth doing nothing. And then it hit the low the other day, and then it went all the way today up to the upper extreme. But I think that's all that's going on in the market. And the question people come, well, they see the breakout to new highs yesterday, and a lot of people say, well, did you see investment money? I didn't see investment money. That doesn't mean there's not some, but I see mostly short-term trading money coming into this market. Look at today, and we're going to look at today's profile, and it's unbelievable that this is the profile exactly up against that upper channel line that I just showed you. You got to, I mean, there's no excess up here. So I think that upper channel line is what I classify as a go, no go level. You know, it either fades from here, goes down, breaks to the upside, or breaks to the upside, gets rejected, and then comes back down. So from right here, I think we're looking at three little scenarios. One, looks above the line and fails, looks above the line and gets legs and get another run to the upside, or it just starts to rotate back down. But it's unbelievably quiet after all the market did yesterday and the way it came up. Okay, I mean, I don't see anything more complicated than that in the market right now. I do think it's very short-term traders. Let me take a few questions on that you might have, or challenges.
We still got people coming in here. I don't have any questions just yet.
Okay, I will. I'll address something that I find extremely interesting. As I said, we just finished an intensive. An intensive is our, 4.5 week big course for really serious traders. But one of the things that we asked the traders yesterday, and today was the final day of the course. One of the things we asked the traders yesterday, what percentage of the traders in the intensive were profitable? And I don't remember, it was either 53 or 58%, which is a high percentage for short-term trading. But the most important question I asked, how many of the profitable traders were faders, and how many of the profitable traders traded go with strategies? Now, that always confuses us. A fader is somebody that, they're always going against the market. The market opens at 1, it goes to 8, they'll sell it. It opens at 8, it goes to, 15. It opens at 8, it goes to 1, they'll buy it. It opens at 8, goes to 15, they'll sell it. They're always going against that. And I have contended for a long time that is probably the most non-productive strategy out there. It's a strategy that was, people first got in the market, they used to teach a lot of reversion to the mean strategies. And of course, you're a fader to do that. My contention has always been to go with the trend, go with the developing value on that day, go with the confidence on that day. The answer was very surprising. The answer was 100% of those traders that were profitable went with the market. They did not fade the market. If you remember, when I had a discount futures brokerage firm in Chicago years ago, the average account lasted seven weeks. I watched this over and over again. People like to fade the market. Anyhow, it's just an observation, and it's a change to a lot of people. If you really want to challenge the market and be profitable, you have to learn how to go with the market and what the market's doing on that particular day at a minimum. Okay.
Okay, we've got questions.
Please.
Okay. Do you see a go with trader as chasing or getting mesmerized by price though?
Well, one of the things that we say, there is no question that momentum is by far the most prevalent strategy in the market. It's the easiest, but it's what most people do. How we position what we do is we say that momentum is the primary indicator, and market generated information is the lagging indicator. Momentum trading, the fallacy for momentum trading, I think, is it doesn't have context. It's all priced based. When we put market generated information around momentum, we are simply adding context to the momentum. But we understand that momentum is the primary driver in the market. And what we do is we put context around that and try and give it a little bit more depth. And and it's a question. Your question about chasing price. There's nothing wrong with going with price if that's what most people are doing. But another thing that we focus on so much in the intensive is, how do you monitor? How do you do a trade, and how do you monitor for continuation? If you learn how to monitor for continuation, and I can't teach you that in a couple of minutes here on a public webinar, but if you learn how to monitor for continuation, then there's an awful lot of trades you can do. They could be price-based trades, but you can do them. Yesterday, the price yesterday, was wild price yesterday afternoon, but the momentum was up in there. So it's always a question of, some people feel they're trading price, but if that's what most people are doing, that's what you need to do if you're going to be profitable. Another thing that we talked extensively about, and a lot of people don't understand this, that a lot of people don't realize that higher prices many times are the result of even higher prices, just as lower prices are often the result of even lower prices. Yesterday afternoon is a great example. We broke out, and the higher prices were actually what triggered even higher prices. So you have to be able to put things in perspective rather than have just a simple view. I don't want to be chasing price. Well, if you know how to protect yourself, sometimes that's what you have to do. You have to chase price, but you have to know how to manage that position. Okay, what else?
Okay, some other questions. Okay. Do you think the market is being held up by a small number of stocks?
I don't really care. Back in, I think it was I forget my age. I think it was 73, 74. Was that the time of the Nifty 50? Tell me if I'm wrong on my years. But at the end of the Nifty 50, and the Nifty 50 is when the bright institutions decided all they had to do was own the top 50 stocks, and they didn't have to do anything else. And of course, they got them to exceptionally high PEs, and of course it fell apart, and that was just another one of the fiascos. But at the end of that run, basically the only stock holding the market up was IBM. Well, so if you're talking about individual stocks, it's one thing. If you're trading the indices, it doesn't make any difference. If that's what the indice is doing, maybe it's being supported by a few stocks, and it may be change risk. But remember, we are short-term traders. If you wanted to address that question being held up by a few stocks and you're talking about your investment account, I would have a different answer. When you're talking about short-term trading, that's a whole different. You have to separate your investment account from your short-term trading account. And focusing on is a few stocks holding it up will probably give you a bias, and that bias will probably cause you to lose money. Okay, what else?
Okay. Somebody's asking if you can explain excess.
Right here, the excess. The market distributes its bids and offers via a two-way continuous auction process. The market auctioned lower until it found buyers. So this moved away, that was quickly. On the upside this morning, it auctioned higher, but it didn't find any aggressive selling. You got some liquidation from people along. Here you got some aggressive buying. Here you got no aggressive selling. You got some liquidation, and that's why you're back here again in there. Okay, lack of excess. One of the things I commented on the night before the market broke out yesterday was, and this is excess on a daily basis. A broader concept, and this you can teach, but on a broader concept, excess is a much more difficult concept to absorb. You have to have some experience, but you can look at, these are the days leading up to yesterday. Here was the high on the 18th. There was some excess, but then you had limited excess here. no excess here, very little excess here, not much excess here because it's so close to this day. This is so close to this. So what I had commented on during the intensive the night before was be very cautious of this because there's no real excess up here. But you might say, but Jim, there's excess here. That's excess on a daily basis. But excess is a more universal concept, and you're looking at this whole market. So what's happening up when market gets up here near this high, there's some selling going on. One of the things that will happen that a lot of times traders don't appreciate is that bigger trading money, after they see this high, they may realize that this area right in here is the high risk. So a lot of times smarter traders, they'll sell here, they'll sell on the rallies up to here because the risk reward of holding positions here is high. They would rather sell here, repurchase on the other side if the market's going to show continuation and gaining a foothold. They'll give you this because they think the risk reward is too high in here. The risk reward isn't correct. So they'll come out here, they'll repurchase here. And this is also one of the reasons why sometimes you get is that higher prices are in fact the cause of even higher prices. Okay, what else?
Okay. Somebody's asking, okay, so doing a go with trade, or from what you were talking about earlier. So doing go with means you don't reverse a trade. Right now it's bullish, but it seems that we've hit a high.
Well, it doesn't say you have to be long. Doesn't have to mean you have to be long. But it's the too many times traders want to, if they see the market up, they want to sell it. If they see the market down, they want to buy it. And this is obviously more complicated than just giving you a short answer here. You have to start off by seeing how much confidence is there in any one single day. And then you take that confidence and you want to trade with the confidence on that day. Now, if the confidence on that day is with the long-term trend, then you got a little more staying power. If the confidence on that day is against the trend, so let's say the trend is down, let's say the trend is up and you get a break today, well, that may be short covering, so or a long liquidation. So early on, you may want to go with it. But then if you know how to monitor for continuation, you don't want to stay with it. Here's see if I can find an example here. Right here on the 5th. On the morning of the 5th, let me say that one of the things about trading, a lot of times we say trading is an art, not a science. And a lot of times people want to make a science out of the market. There's too much irregularity that goes on in the market in order to be anything. It's everything but a science. For example, on this day right here on the 5th, news came out that Apple sales in China were weak, and there was a couple other negative on some tech stocks. So the market broke really high. We were live during the intensive, and what we watched this day, we watched the tempo. Tempo is the speed, was indicating to us that the market was getting very short or short in the hole. Short in the hole meaning shorted poor prices. And of course, we were talking about it 2 hours before the rally started. We could see it develop. So you started off with high confidence in the morning. So the high confidence, go with it in the morning. That's where the high confidence is. Monitor for continuation. And then the market, and I'm going to split this out a little bit. It'll make it a little bit easier to comprehend. This is a liquidating break. This is the letter B. That's an indication that it's liquidation, not a combination of liquidation and new money selling. Now, price-based traders don't understand how to interpret this structure. All they're looking at is price. And remember what we said, what we do is we put context around momentum. So we're very, we honor momentum, but This tells us that this was liquidation, not a combination of liquidation and new money selling. Now, price-based traders, they come in the afternoon and they're just frantically selling the market down, not realizing the message here. They're getting short in the hole or short at poor prices. And so many short-term traders, they just follow what everybody else is doing, and that's what gives these problems. So the market got too short, and sometimes when there's no excess, that's an indication that the markets are too short. That's another message. But the tempo was terrible. And of course, you see what happened. You got the late rally, and then you got the follow through for the next couple of days. So again, there's an awful lot to understand when you're talking about, short-term trading. Short-term trading is very difficult. One of the things we say sometimes, the market you're trading is yourself, because we defeat ourselves. You're always trying to make sure that you don't beat yourself in the market. Okay, what else we got?
Okay, how can you tell the difference between short covering and new buyers? For example, yesterday post FOMC.
Value is higher, momentum, speed. The biggest thing yesterday, and let me split this out. The biggest piece of information yesterday was in K period, and we replayed this morning for our intensive. Like I say, this was the last day of the intensive. When the market started down in K period, early on in K period, the tempo was very slow. Like I said, I can't teach you tempo. I can tell you about tempo. You have to learn tempo from experience. I can't teach you how to short-term trade. You have to be self-taught. But I can mentor you, and I can show you the things to consider. It's the same with tempo. But when this market came down yesterday, the tempo was absolutely terrible. And this is why we replayed it this morning, to show what we were talking about. And of course, then you got the big run up. Additionally, on the correction in L period, when the market tried to correct in L period, the tempo was also equally slow. So again, that's the biggest indication that you have going for you. But that's part of the artwork. Okay, what else we got?
Okay. I have a bearish bias and I can't seem to maintain an even bias. Could you address how to get rid of this bearishness that I have?
Well, sure. First of all, you're a short-term, if you're an investor or a short-term trader, it makes all the difference. As a short-term trader, and that's really what my market is. The market we're talking about is short-term trading. Your short-term trading, guess what? You get markets that go both ways in there. We start off, you talk about that bias. So let's start off and show what I do every day to fight that bias. I start off every day by looking at the monthly chart, because I well know that at the end, I'm a short-term trader, and I know at the end of each day, I may be bullish or bearish on that day, depending on what that's doing the last thing. So as soon as the market's closed, I go to the longest time frame. I go to the daily bar or the monthly bar. 1, 2, 3. But we've been one time framing higher for 5 months. So whatever you want to be, the market's telling you you're wrong. Oh, I was right, but I was too early. No, you were wrong. And so look at the reality. Now, from there, the next thing I do, that's my biggest picture. Then I come down and I go to the weekly. And when I look at the weekly, I said, okay, now it's not one time framing, but you can see along these lines, it's going higher. 1, 2, 3, 4, 5, 6, 7, 2 weeks. So you're bearish. You're killing yourself. You're killing yourself. Your ego's getting in the way. As a short-term trader, deal with the reality of what's going on. So then I go the monthly, the weekly, and then after that, then I go to the dailies. And where's the, um, okay, and then you see here, now I get a little different picture. Even if I start here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21, 22, 23, 24. So the trend is still up. Remember, the monthly, the weekly trend is still up, but you're getting a lot of rotation. And this is what I say, this is why I think there's a lot of late laggards in the market. But they're doing they're mechanically trading off of, things that they can see and do. So again, forget your bullish and bearish, trade the reality. If you want to be a profitable short-term trader, trade the reality of what's the market's going on. Remember what I said to start with. So many times, the market that we're trading is not the stock market or the index market. It's ourselves. Don't beat yourself. When you get these bearish biases, do what I do. I mean, I've had them. I know how costly they can be. Do your homework every night. Take a look and say, what is the market doing? And what the market's doing, that's the way the trade's going to go. Okay, let's take a short break. Jen, you want to do a commercial, a little more formalized commercial, and then we'll come back and take a couple more market questions.
Okay, yes, because we do have several questions here from folks, but let me take the screen back temporarily here. Okay, so I just want to go over this for folks that are new. You can go to our website, jimdaltontrading.com, and then go to courses at the top navigation, and you'll see that the primer is featured here up at the top, and you'll find details, and it runs from April 10th through the 18th. And you'll see here that we do have a schedule posted. The times posted are in Eastern, so you would need to adjust for your time zone. But all of the webinars are recorded in case you can't attend a session live, or maybe you've got a day job for which you know you won't be able to attend any of the sessions, depending. And they're all recorded so that you can review. You'll get access to your materials for 3 months after the course finishes so that you got ample time to review everything. But it's an 8-day course. It's a short course that gives you a great introduction to market profile if you're completely new, or if you are somebody that is experienced, to learn and make sure that you understand some of these foundational concepts as Jim intended them, because I can't tell you how many students we get that will come take a class with us and say, well, this is how I learned it from elsewhere or a different training, and there was misunderstandings or something. And then also for those of you that are seasoned, know your stuff, but you like to have a good review, and you'd like to join us more so for the latter 4 days where Jim is narrating the live markets and we're providing live commentary and daily reports. It's a great value for what we provide and for the time that we spend with you and what we go over. If you've got any questions, by all means, you can shoot us an email. Our contact information is at the bottom of our screen here. You can call me. I'm happy to answer questions. I want to say what differs from the foundation e-course and the primer, the differences between the two, because I often get that question. And that is the foundation e-course covers more than what we can here in the primer. But we do take the first few linear teaching lessons from the foundation e-course and turn that into a live primer so that you've got a live environment, you're able to ask questions. And then something else different that we do specifically for the primer is on the 4th day, we do a plotting of the market profile exercise. So for those of you that do not have market profile charts, you don't have to have charting to take this course. And for those of you who haven't decided to invest the money yet in software, or you're not sure which software you want to subscribe to, you can plot it manually, and we teach you how to do that as an exercise so that you don't have to spend money on software if that's something that you're not wanting to do.
I did it manually for the first couple of years.
Yeah, that's exactly what Jim did, and he did that for what, 7 or 8 different markets, Jim?
Yes.
So the other thing that I'll just mention here, that if you're not able to join us for the primer, you're not wanting to do the primer, the foundation and application of the market profile e-course is another place to begin, and also so that you can qualify to take a live intensive with us in the future if that's something that you're wanting to do. Our e-courses are never on sale unless we bundle them for when we're having an intensive. I'll also just mention in a general sense, purchasing early will always yield you the best price. And as you can see right now, the primer is on sale for $449 until this Sunday, March 24th at 11:59 p.m. Eastern. Okay.
Okay,
Okay. I'll give
back
you
to the
back.
market.
Yep.
Okay.
There you go. And we've got some other questions here.
Okay. Now, remember, the primer does not qualify you for the intensive. But that's a lot of times people are mistaken about that. The foundational e-course or having been a prior intensive participant. Okay, so the market, we showed you the graph before, but what's going on in the market, you can see what it's doing here. It's right up against this. It's still there. This is an indication to me that it's probably pretty short-term traders in here. Okay, questions on the market or questions on anything?
Right. Do you think that the current slow tempo is the market getting too long?
Tempo on the upside and tempo on the downside are entirely different. Our real focus is on tempo against the trend. Up here, it may just be that that there's just no buyers up there. I mean, I think it's so many mechanical short-term traders in the market. And if they don't get through that level, then all of a sudden they can turn to sellers. Okay, what else?
Okay. Does Jim think it's possible that now the market may be getting too long in the near term, given that we've got all these matching highs for 4 periods?
Well, it's like the trend is up, right? The trend is up until it changes. You got a huge gap. I mean, there were no sellers. I mean, anybody longer term money could have sold all day today at higher prices than they've seen in a long time. They weren't there. Whether they materialize, what can happen? You can get just a little liquidating break in here, get some of the short-term inventory rebalance, go back up. You can get short-term inventory that starts to feed on itself on the downside in here and fill this gap. But right now, there's nothing going on in here. There's absolutely nothing going on in here. Just relax. One of the things I constantly say to people, you are usually better off being a little late rather than being early. So many people are afraid they're going to miss something, and they lose a lot of money being afraid they're going to miss something. If this thing's going to break, I mean, a narrow base like this, either up or down, don't worry about it. Just step aside until the market makes the decision. Trying to outthink it will be very costly. Okay, other question.
Okay. Jim, you said that we were in the laggard part of the buyers. Do we have any signs that innovator sellers are present right now in the market?
I haven't seen any. I haven't seen any in there. The market, when you think about this is where a lot of times the longer term investment money, remember, they make their money by time in the market. Short-term money makes their money by timing the market. The long term has more than likely been in this market forever. They may add to a little bit, subtract from. Usually January, February are pretty decent months for the market, and particularly for the long-term investment managers, because the pension funds, foundations, endowments, make heavier commitments early in the year. So they add some new money, to them, and they have to put that money to work. They don't have to, but usually they do. But I don't see any indication of them selling. And if you think about over the period of time, the long-term money, they may become more defensive. Maybe they rotate out of one industry into another, change some groups, but generally they stay pretty well fully invested. I mean, a couple, 2 to 3% is underinvested for a lot of those funds. And a lot of times what happens is you don't see the long-term money really start to sell until the market's down 7, 8% or so. And you and I panic when the market moves, 100 points or so. The long-term money prides himself on not being like us. But what happens when the markets, move 7, 8, 9%, they start getting calls from their clients. And as they get calls from their clients, then, they start to feel the pressure. And this is why the old adage, and people use this a couple times in current intensity, say markets, go up like a stair step and down like an elevator. Well, people overwork that, but there are times when you start to get long-term selling. It feeds on itself, and you will see the market will just plummet down in a few days or a few weeks. It goes down much, much faster. But so far, I haven't seen any sign of selling. And why should they? The market's going up. Okay. What else?
Okay. Somebody's asking, what can we learn from the tempo over the last few hours? I'm a very new trader, and it's like drinking from a fire hose here.
Well, there's nothing going on. There's nothing going on up. There's nothing going on down in here. The overall trend is up. I showed you, what's going on, that the market is right at that, they're very at this mechanical level, and it could all of a sudden, it could ramp this way or this way very quickly. So at this point in time, you learn nothing. You sit, what is the message? There's nothing going on. Walk away. Remember, I said earlier, sometimes you're better off being a little bit late rather than a little bit early. A little bit early, get chopped up today. Okay, final couple questions, Jim.
Okay. Why do you only trade the ES? Is this the market that has the most beautiful structure to look at in terms of context, references, etc.?
I used to be a bond trader because the bond market was the most efficient market in the U.S. And then, the government got involved, when they started, policies in order to shore up the market. And that took the trading opportunities for me out of the market. The next best, most efficient market is the ES. Actually, the best market is the SPY. And the only reason I don't trade the SPY is because it doesn't trade overnight. But basically, I'm going to be 84 this summer. I absolutely, been in the markets almost all my life. I've had memberships on the board of Chicago Board Options Exchange. I was number 2 at that during the early following years. I've had memberships on the Chicago Board of Trade. I ran hedge fund research for UBS. I love the markets. I love the markets. I love trading. I love teaching. And most of my, I don't want this to sound, sad, but most of my friends have passed on. And believe it or not, I enjoy teaching, but I also enjoy some of the relationships that I have met through the relationship of teaching the trading. I enjoy it. I enjoy it a lot. I do it. We do. Like I say, we finished an intensive today. We'll do one in June, and we'll probably do one late in the year. And I'll do these, and then then maybe I'll do some traveling. The next trip I've got coming up, I'm going to take a trip on the Snake and Columbia, river. That's I think it's about nine days. So I'll plan things like that. Last year I took a Mississippi river trip. Went to Nashville and Memphis, and but I'll just get out and do some traveling. So, but I mix it up. This keeps me busy, and I enjoy it. Final question.
Okay. What is the difference between tempo up and tempo down?
Okay.
That they're
Tempo,
different.
if the trend is up and the tempo down is slow, that tells you that the offers or the selling has dried up. So when the tempo is slow going down and the trend is up, generally speaking, the buyers will reappear. If the market's going up and tempo is slowing, it can just tell you that the buying is, there's not much buying going on, but it's not building up. It's against the trend, so it's not as likely to lead to selling. Everything that we learn is contextual. Trading is an art, not a science. So, there's no nice, simple rules, do this if this happens, etc. And so your question's a good question, but the answer is so dependent on what is the trend at the time. All right, let me say thank you very much. I do hope you consider joining us for the primer. And if you're looking for the big course, the intensive in June, remember you're going to need the foundational e-course, and you need to get that under your belt early so that you really have some appreciation when we get into the heavy duty intensive, which lasts 4.5 weeks. And I leave you with the final survey we did yesterday. I don't remember, it was 53 or 58% of the people in the intensive were profitable. 100% of those people were doing go with trades. They were trading with the trend. They were trading with the trend and not faders, not always going against the market. 100%. I was astounded at the answer. Let me say thank you very much, and we'll see you on the next intensive. Bye now.
Thank you so much, everybody. And if you have any questions at all about the primer, what course is right for you, please give us a call. I'd be happy to speak with you and answer any questions that you have, or shoot us an email. Thank you so much, and take care. Bye-bye.